Looking at this building in London, you are seeing the headquarters of HSBC. It is a British universal bank, but it derives its primary profit growth from deep historical roots in Asia-Pacific, serving 39 million customers globally. Compare that to these twin towers in Frankfurt, the home of Deutsche Bank. It is Germany's leading financial institution, a bank that has spent the last 5 years grinding through a severe restructuring program to stabilize its capital base and return to profitability. By the end of 2024, the absolute disparity in size between the two was stark. HSBC reported total assets of $3 trillion. Deutsche Bank reported approximately 1.3 trillion euros, less than half the footprint of its British competitor. This chart tracks the profit trajectories of both banks from the 2020 pandemic low to 2024. Notice the steep ascent of the HSBC line. The bank executed a sharp recovery, posting a return on equity exceeding 12% for 3 consecutive years and reaching nearly $30 billion in pre-tax profit in 2024. Now look at the lower line, representing Deutsche Bank. While it successfully transitioned away from its 2019 losses, its trajectory plateaus. It generated a much narrower 5.29 billion euros in 2024 pre-tax profit, with a peak return on equity of just 7.85%. When global investors look at these two performance profiles, they assume they are viewing a direct one-to-one economic comparison. Because both institutions publicly prepare their financial statements under international financial reporting standards, the assumption is that the rulebook is identical. That assumption is false. Surface-level metrics hide deep structural accounting disparities. Without translating the math beneath the numbers, a direct comparison is impossible. International Financial Reporting Standards, or IFRS, are the ostensibly unified accounting framework designed to align financial markets globally. In practice, IFRS is not a single monolith. Instead, it is a fragmented set of regional dialects. Regional regulators frequently modify the rules before endorsing them. They carve out exceptions and permit local interpretations. These modifications warp the calculation of assets and liabilities, creating distortions for anyone conducting cross-border equity analysis. By deconstructing the 2020 to 2024 financial statements of HSBC and Deutsche Bank, we can expose exactly how these hidden regulatory dialects operate. To accurately value a global banking titan, an analyst has to strip away the regulatory noise and isolate the underlying economic reality. HSBC provides a clean analytical baseline. It applies IFRS exactly as issued by the International Accounting Standards Board. There are no regional adjustments. Deutsche Bank operates under a completely different framework. Because of its jurisdiction, it is subject to dual regulatory oversight, which forces the bank to maintain a dual reporting structure. First, Deutsche Bank must satisfy the European Central Bank. For this, it prepares an annual report using the EU-endorsed version of IFRS. Second, to access American capital markets, Deutsche Bank must file a Form 20-F with the U.S. Securities and Exchange Commission. The SEC does not accept the European version of the rules, so this filing uses the standard IASB IFRS. The conflict between these two filings comes down to a specific loophole known as the EU Carve-Out. Under standard IFRS, the rules for portfolio hedge accounting are incredibly strict. The European Union decided those rules were too restrictive for its banks, so they legally carved them out, permitting broader hedging tactics that the International Board explicitly prohibits. From the same physical building, Deutsche Bank publishes 2 different ledgers. By applying the EU carve-out, the bank hedges risk across large portfolios. Because the SEC forbids this, the 2 balance sheets calculate different final equity values. These are not rounding errors. They are material deviations in reported profit and total equity for a single economic entity. An analyst trying to compare HSBC to Deutsche Bank has to navigate this trap entirely manually. HSBC only has one set of numbers. Any cross-border model is structurally flawed unless the investor explicitly specifies which legal version of Deutsche Bank they are analyzing. Accounting models are theoretical until tested by extreme stress. That test arrived in 2020 with the economic freeze of the COVID-19 pandemic. Under a rule called IFRS 9, banks do not wait for a loan to default before recording a loss. Instead, they must record expected credit losses using forward-looking macroeconomic models. This expected credit loss model requires management to assign probability weights to upside, base, and downside scenarios. In 2020, teams shifted weights into severe downside scenarios and added manual overlays, causing Deutsche Bank's provision to spike to $1.23 billion. Taking these massive provisions directly against revenue severely suppressed the 2020 reported profits for both HSBC and Deutsche Bank. In 2021 and 2022, extreme downside scenarios failed to materialize. Because defaults didn't happen, banks released unused pandemic provisions back into income statements, mathematically fueling massive spikes in return on equity. Look closely at the timeline. Much of that profit surge was not derived from an operational breakthrough, but from the unwinding of overly conservative accounting models engineered 2 years prior. During periods of crisis, headline return on equity often measures the severity of a management team's pessimism rather than the bank's actual cash-generating power. Now, apply this complexity to an American institutional investor or a U.S. bank attempting to acquire one of these European assets. The industry relies on the myth of converged accounting, the belief that IFRS and U.S. GAAP are similar enough that direct comparison is safe. This conflict centers on loan loss accounting. Under IFRS 9, banks provision for only 12 months of expected losses on healthy loans, but U.S. GAAP forces banks to recognize lifetime expected credit losses on day one, making the immediate deduction massive. The math dictates the reality. Converting HSBC or Deutsche Bank to U.S. GAAP instantly erodes their capital base purely through a change in the calculation methodology before a single physical operation is altered. A second major trap lies in the valuation of insurance contracts. Consider HSBC's vast Asian insurance footprint. When HSBC adopted the new IFRS 17 standard for insurance accounting in 2023, the transition alone wiped out $10.5 billion from its opening retained earnings. If you were to translate that same complex insurance portfolio to U.S. GAAP, you would trigger rules for long-duration targeted improvements, scrambling the bank's earnings recognition pattern entirely over again. Cross-border mergers and acquisitions executed without a granular conversion strategy are dangerous. Until properly translated, the target's balance sheet is a legal optical illusion. Returning to the initial comparison between the two banks, the raw data clearly points to HSBC's structural outperformance over the 5-year period. HSBC maintains a resilient 14.8% Common Equity Tier 1 capital ratio and commands vast relationship banking revenue driven by its presence in the Asia-Pacific region. Look at the trajectory chart again. The margins of victory are highly parameterized. To find the true baseline, apply strict mathematical filters. First, normalize Deutsche Bank's EU carve-out anomaly. Second, standardize their expected credit loss assumptions. Finally, extract HSBC's foreign currency translation distortions. A balance sheet is not an objective physical measurement of reality. It is a human-engineered model, shaped by jurisdictional rules, local carve-outs, and management bias. In the highest tiers of global finance, mastering the operational business is only half the equation. The true advantage belongs to the analyst who decodes the architecture governing the numbers.